Banks across the pond seem to be in crisis mode, and things might get even worse for these financials. Dom Chu's in the newsroom breaking it down. Dom.
Well, those European banks, Melissa, have had a rough go of it. It's been probably a longer-term trend for some of the most embattled European financials. I mean, just look at shares of Deutsche Bank. Another day, another record low. It's lost 16% of its value year to date. It's lost around 39% of its value in just the last 12 months. Now, for perspective, in May of 2007, pre-financial crisis, those shares were trading above $159 a piece, and today they got as low as around $6.64. According to data from FactSet, Deutsche Bank shares now trade at 20% of book value, or an 80% discount to book value, depending on how you want to look at it. Other big name banks in Europe are also trading at deeper discounts to their book values. Fellow German lender Commerzbank trades at 28% of its book value. Societe Generale in France trading at around 33% of book value. UniCredit in Italy trades at around 39% of book value. And then Barclays in the United Kingdom trades at roughly 48% of book value. Some traders will make adjustments and look at a measure called tangible book value, but the story pretty much stays similar. Many of the biggest brand name banks in Europe trade at a discount valuation to their U.S. counterparts. And Melissa, not sure exactly when investors will call a bottom in those valuations, but it's certainly a trade theme we'll pay attention to. Back over to you.
All right, Dom, thank you. Dom Chu in the newsroom. Guy Adami, you've been on the Deutsche Bank drumbeat for a very, very long time.
Yeah, and to think it's just Deutsche specific, listen, I don't know, but I would say, listen, you can't say it isn't. You have to at least have some semblance that maybe it is systemic. I think it is. It's the largest derivatives book ever. And you look at where Citibank trading. Citibank, tangible book in Citibank is $65, close to $62.5. Why? In my opinion, European risk. Deutsche Bank is a mess, in my opinion, that will continue to go lower. And we're not just saying it today. We've been saying that for the last 2 years.
You're more on the value side, so do you see any value in these?
I do. I do see value. And I do think that there's a dynamic here with the ECB where if at one point you thought they were going to start to begin hiking sometime in early 2020, in March, as most people, they pushed that back probably to September, probably to December, if at best. You hope for that environment. So I like the banks. I think, we talk about $13 trillion in negative yielding assets. They have most of them. And I think this is a tough environment with the ECB. Hands are tied.
All right. Now, European banks may look like they are in crisis mode, but our next guest says they could be showing some signs of life. Bob Michael is the global head of fixed income at JPMorgan Asset Management. He joins us for more. Bob, let's be clear. You like the debt side of things here.
Yeah, but there are a lot of good things going on in European banks. If you look at asset quality, it's improved every single year for the last 3 years when measured by non-performing loans. And that's including in some places like Italy, which everyone feels they should be concerned about. When you look at non-performing loans, the last 3 years, they've dropped from close to 18% to 8%. So that's a very good story there. On top of that, the banks have spent the post-crisis environment raising capital and investing that capital in somewhat riskless securities. They have these fortress-like balance sheets. I think this is where debt and equity investors come to a fork in the road. As a debt investor, I like the certainty of return of capital. If you're an equity investor, the return on capital may be a little bit low.
When I understand that you're looking at the fundamentals and you see what you see, but does it get to a point where you take a look at a Deutsche Bank, let's say, and you see the stock making new low after new low, and you think it could get sucked into this sort of vicious vortex of the stock goes down and then it's difficult for them to service their debt?
Sure. There are always situations like that where you're looking at the leverage of the banking system. I actually think Deutsche Bank is a specific example. They were very slow to reorganize coming out of the financial crisis. They hung on to too many losing lines of businesses and were late to reform largely around a consumer and commercial bank.
So, Bob, I'm curious, is there a world or a scenario where the equity of these banks could go close to zero, right, or zero, but the bonds do really well? Because you look at credit default swaps, and they haven't moved at all. So it seems like the bonds are the place to be. Equities might go much lower.
No, I think that's probably a bridge too far for me. I like something there at the bottom of the capital structure to protect me. I think as soon as you start talking about zero equity, you're talking about reformation, restructuring, and ultimately the debt investors get pulled into that, particularly now that all of a bank's bonds are eligible to be bailed in to bail out shareholders. So that's kind of the Mason-Dixon line you cross there.
So, Bob, you mentioned Deutsche Bank is probably Deutsche Bank specific. I respect that opinion, but is there a chance that that derivatives book they have is sort of the ticking time bomb, not unlike what we saw 10 or so years ago with a Lehman Brothers or a Bear Stearns?
I don't think so. I think to believe that, you have to assume that all their counterparties are naive about the exposure at Deutsche Bank. And I think that their counterparties have managed to lay off a lot of risk outside of that.
All right, Bob, we're going to have to leave it there. Thank you so much for coming by.
Great, thank you.
Bob Michael.
Yeah, but so that risk looks like it's been disseminated among a lot of other European banks. Just look at the equity, look at the SX7E, that's the Euro Stoxx Bank Index. It's banging along a bottom that it's been trading at since the post-financial crisis. The low, I think, in 2009 was somewhere like 85. It's trading just above that. During the Euro, when they finally were starting to get their act together, 2011, 12, it traded as low as 72, 73. So the equities across the region and the banking industry, they trade very badly. So the fact that they're not just isolated at Deutsche Bank, whose equity for all intents and purposes is a donut, it's a zero, it's going there. They can't even merge with the other biggest bank in Germany when they were told to do so by their regulators. So to me, I actually think just look at the equity is telling you that the problems are far from over.
So the EUFN is the ETF you can use that actually gets you exposure to the European banks. Dan points out, down 86%, especially in essentially cap-weighted terms because of all the dilutions since the highs of before the crisis. So it's been an ugly trade longer term. But as Bob pointed out, the balance sheets aren't as bad as people think. Your biggest issue is that the net interest margins are terrible because of where yield curves sit in Europe right now. Until that gets better, I don't think you're going to see much on EPS, but is there a value play there on a balance sheet? Yes.
There might be, but I still think the equities have a long way to go. But you look at the credit default swaps, they're not moving. So this is not a 2008 scenario. I think that's really important. You have a lot of people out there, particularly ECB, ready to step in here. So I don't think it's a 2008 scenario, but that doesn't mean that Deutsche Bank stock can't go to $1 or $2.